Yes, your house is an asset. Why is a house an asset? Because it builds what you call equity. And there is a way that we determine what your house is worth if you want to take the next step and get an appraisal on your property to see how much equity you can have and you can take out, and whether you can afford to take that equity out. Those are very different things. Most real estate investors start out like this. They buy a house, then they live in it, then they pull equity out of it after a few years of living in it, buy another house, then rent that out, and they so on and so forth. And they have a big real estate portfolio, and you wonder, how the heck does this person buy one property a year? Well, that's how. They barely touch any of their own assets. They barely touch any of their own investments. They just use the equity and the growth of the real estate market as an opportunity to go and invest into other properties. This is how people grow wealth here in Canada.
Hi, Helen. How are you? Welcome to the show. Again, thank you so much for being here.
Thank you so much for having me. It's great to be here.
Helen, I would like to explore the option to look at your house as a tool. Instead of looking at an expense in your life because you are paying your mortgage, where is the point where you can look at that asset as an asset and get profit or benefits or more money from it? Is there any chance to do that?
That is a really good question. Really good question. So, yes, your house is an asset. It's a liability to a lot of people, but in reality, anybody who's financially wealthy who works in real estate or has grown their wealth through real estate knows that a house is an asset. Why is a house an asset? Because it builds what you call equity. What is equity? I'll give you an example. You bought a house for $500,000 5 years ago. And let's say you only did 5% down payment, which is the minimum requirement here. Let's say now the house is worth about $700,000 just because the market has grown over 5 years significantly. These are not exaggerated numbers. These are in Halifax. These are real numbers. This is very realistic. If you bought a house 5 years ago, you have it has grown in equity
And
between
more.
$150,000 to $250,000. That is very realistic. This isn't just some random numbers. This is the reality in HRM, right? So it's a reality in a lot of places in Nova Scotia and other provinces as well, but we're talking about Halifax specifically today. So let's say that that's the scenario. $500,000 purchase price, you did 5% down payment. Talked about this in the previous episodes. You pay insurance premium, which is 4%. So really, you only did the 1% down payment. Really, that's what you did. And then you pay off the mortgage, just do the bare minimum payments over the 5 years. But the real estate market's still growing here. It's still booming. It's still crazy. You still have a lot of people buying and selling. There's still a high demand for real estate here. And so your house has grown and now it's worth $700,000 based on what other houses are selling for in your area. And there is a way that we determine what your house is worth if you want to take the next step and get an appraisal on your property to see how much equity you can have and you can take out, and whether you can afford to take that equity out. Those are very different things.
And how can you do that?
Talk to me. You talk to me and you say, Helen, I want to use the equity in my home to invest in some real estate, buy another property, pay off my debt, send my son or my daughter to university and pay off for university like that because they can't get enough money from student loans. I need money from my house because it is an asset and I've grown equity in it and I'm ready for the next step. So how do you do that? You talk to a mortgage broker, you talk to your bank. I prefer mortgage brokers because we have more options for you. Your bank may very well say not to do it because for them, depending on what's going on in the market, you could be locked into a very high interest rate right now. You could be locked at 5%, but then this year you say, well, I want to refinance, and refinancing, let's say at 4%. Your bank is not going to want you to let go of that 5% interest rate right now. They want you to stay and locked into that. So they're going to dissuade you from that, most likely, right? Because for them, it's loss of money. However, you talk to a good person at a bank or you talk to a good mortgage broker and they'll say, yep, that's definitely an option. There's equity there. It seems like it's doable. So from my perspective, what I do is, and I'm by no means a professional appraiser or any kind of assessor, but I do look at how appraisers approach this. An appraiser is somebody who is a licensed professional in each province, and they work for a company or work for themselves, and they do assessment of your house of what it's actually worth. And how they look at it is they look at 3 other properties. So what you do is you compare, right? You take the same square footage, the same neighborhood, and you look at your house, how many bedrooms, how many bathrooms, the style of the house, and you compare it to a house that has very much similar, it's pretty much the same, but a little bit worse. Like, let's say the house is in worse condition. You look at a house that's in about the same condition, and you look at a house that's in slightly better condition than yours. And these houses have to be sold in your area within the last 6 months. If not within 6 months, I believe they extended to about a year. But normally they want to look at the last 6 months of sales in your area and tell you what your house is going to be worth based on the average of that. And they come and they look at your house, right? They take pictures, they assess the house value, what they think it's worth, and what the lifespan of the house is. And that's how they look at it. So for me, I do a very basic version of that. I look at your house online, and then I look at some comparables in a similar way, and I'll say, yeah, I think that could work. Like, I think that's a good, I think your house might be worth $700,000 based on just what's selling in your area over the past 6 months, right? If you come to me and you say, well, I think my house is worth $1 million, and I'm looking at the sales and nothing sold for over $700,000 in the last half a year, I'm going to probably tell you probably not.
Probably even with appraisal, you won't have any good income. And for this option, what is the biggest requirement, or what is the first requirement to access to these funds?
Application. So you have to do another application because you are applying for another mortgage, right? You're not just, yes, you own the house and you've been making good payments on it and you have never missed a payment, but you're looking for extra money. You have to qualify for that extra money, just like you would if you're going to a bank for a loan or a line of credit or a car loan. You have to qualify for it, right? So it's the same application as, or similar application to purchasing a home. We look at your financial situation. We look at your income, your debt overall. We look at what it is that you're looking to do with that money, because I have to disclose that to a bank. I have to disclose what are you doing with this extra money, because you're borrowing it from them, right? I have to tell them what you're doing with it, And so realistically, when you're looking at this application and doing an overall view of it, every scenario is different, but you still have to qualify and it has to make sense. So for example, if you come to me and you do have $100,000 worth of equity and you want to use that to buy another property, but you have a ton of debt, the bank might come back and I'll tell you this before the bank does, but the bank will come back to you and say, well, we could give you money, but you got to pay off all your debt first. Like, there's no way you can carry on another $100,000 when you have, a $50,000 car loan and $10,000 worth of credit card debt. You're gonna have to pay that off, or at least pay off partial amounts of that before we can give you more money. Because even though we think you can afford it, it doesn't make financial sense to the bank. It's not realistic. So they want you to do something else. Now, if you're just looking to do debt consolidation, which is refinancing and paying out all that debt, there's a high chance that they're going to approve you, and the interest rates on refinancing are slightly higher than mortgage renewals, and it depends on what category you fall into. So then we have different types of lenders. You have A lenders, B lenders, and C lenders, which are private lenders, really. And we look at your category. So if you go to your bank, which is why I say talk to a mortgage broker, because we have more options. You go to your bank and they'll say, oh, you can't afford to refinance. You just can't afford it. Like, yes, there's equity in your house. There's a ton of equity in your house, but on paper, for a big bank is very constricted to what they can offer because they are a Schedule A bank. They have to follow certain guidelines. They have a certain risk threshold tolerance that you have to meet. So they'll say, sorry, you cannot, based on our ratios, based on our stress test, you can't afford this, right? So then you think, oh my gosh, well, I have so much equity, but I can't afford to take it out. I can't even afford to pay off my debt. Because the stress test on paper doesn't make sense to the bank, and they have to stick within that guideline because that's their policy. But if you go to a broker, I don't have to go with that bank. I can go with any bank really that I work with who will fit you into their policy. Normally I look at who I can fit you in with at the best interest rate for you, and also who can meet all the requirements that you want. And for example, if we can't find anybody within whatever it is that you're looking to do, I'll say, okay, let's meet in the middle. If you want to invest 100 grand into a house, can you at least take some of the money and pay off the 10 grand on your credit card debt, right? Because then it makes more sense to this other lender who's willing to give you the money. And so then you have 90,000 instead of 100,000 to still invest into this new house. You could afford to do that. And you have less debt now because you don't have 10 grand worth of credit card debt. So that's another option that you could look at. And there's so many different scenarios for this and so many different strategies that people use as their house as an asset and use equity as that asset, right? Most real estate investors start out like this. They buy a house, then they live in it, then they pull equity out of it after a few years of living in it, buy another house, then rent that out, and so on and so forth, right? And as depending on the market and how fast the real estate grows and how fast the equity grows, they do it multiple times throughout the year, or they could do it once every year or once every couple of years. You always see people coming back to you and they have a big real estate portfolio and you wonder, how the heck does this person buy one property a year? Well, that's how.
If you are finding this helpful, subscribe now to access our complete series of Canadian mortgages and master your home buying process.
This is how they do it. They barely touch any of their own assets. They barely touch any of their own investments. They just use the equity and the growth of the real estate market as an opportunity to go and invest into other properties. This is how people grow wealth here in Canada.
And talking about the equity, how long does it take to build it? Is there any time? Or, for example, I can buy a house today, and because of the market, tomorrow, can I access to my equity? Or this is not working like that?
No, usually you have to wait 12 months. Okay. Most banks will not want to touch your mortgage for at least 12 months unless something specific happens. But realistically, any bank, any A schedule bank, any A lender that you go to will want you to have a mortgage with your current lender for at least 12 months. And if you are breaking that mortgage and it's really for like moving or for some kind of other situation, you're selling the house, but not to refinance. Mm-hmm. To refinance, most of them will want you to own the mortgage that you're currently with for at least 12 months.
And I think that is one of the main difference about giving the 5% down payment and the 20% down payment. Is that correct? I am not sure about that.
Yeah. So when you do 20% down payment, you automatically own that 20% worth of equity in your home. So when you refinance, you always have to own at least 20% of equity in your house. So your home equity has to grow by a certain amount in order for you to borrow money. So you have to own at least 20% of equity. Like we're talking about Halifax, where somebody just got $200K worth of equity. So they have that 20% where they can keep that and then mortgage out the rest and take that out as cash or whatever they're investing in. But if you're doing 20% down payment on a purchase of a house, you're automatically starting with that equity. The problem is a lot of people don't have 20%.
Most of the people, I think.
Most people don't have 20% equity unless they're already sold a house and they're relocating and they're buying another house. Most cases like that, then yes, they have that kind of equity. And I will always tell people that if you have 20% down, put that down, because when you're paying into mortgage insurance premiums, at the end of the day, I don't feel like it's worth it for a slightly lower interest rate. That's a whole other topic. There's other strategies that we could do where you could do 19 or 20% down payment and still get a good rate and still pay a tiny insurance premium. That is a whole other topic of conversation. On
so just to clarify, someone who buys their home today and they get assistance from the first time buyer from Nova Scotia and they get the 5% in a loan from the provincial government, they cannot apply to that refinancing, right?
You can if you still have equity in your house.
Okay, yeah. But after the 20%.
Yeah, after 20%. Okay. At any time, if you only grown 10 or 20% of equity in your house, I will tell you whether there's equity enough to refinance and take any money out. You might have grown a tiny bit of equity, but not enough to refinance. So at all times, anytime you refinance or take out a home equity loan out of your house, which is a line of credit that is attached to your mortgage, you have to always own 20% of equity in your house when you're going through the strategy, because then if you don't, you're looking at stuff that I can't offer you as a broker from here. There are other options. There are banks that can do that. You're looking close to like private lenders, high interest rates. At that point, I'd be asking you, why are you doing this? Why do you need this money? That you're pulling more equity than 20%. It's not a strategy that I recommend or use, but you've seen people do that before. It's not uncommon, and it's not something that I recommend.
Okay, so what are the benefits from getting access to this kind of financing?
I think for most people, when I look at people's financial situations, their house is an asset that grows equity over time, especially if they take good care of it and if it's in a decent area that's not losing equity. And what I mean by that is if you bought $1 million house in the middle of nowhere, 3 hours away from Halifax, that's not a marketable place, and it's still worth $1 million today because you overpaid for it 5 years ago. I mean, that's on you and your realtor. And if you have a good realtor, they'll tell you that you're overpaying for it. But if you're in Halifax and even 5 years ago when you overpaid for a house, your house has still gone up in equity significantly just because of our real estate market here. So it really does depend on location as well, and you want to talk to your realtor. And you might even ask your realtor, okay, if I was to sell my house, what is it worth today? The value that your realtor will give you is always going to be higher than what we will appraise it for. So when you go to a mortgage broker and you say, well, my realtor said my house is worth $800,000, and I'll say, that is great. That is possibly what you could get it on a resale right now. But when you do an appraisal, it's always going to be less. I would say generally it's about 20% less than what the realtors say. Mm-hmm. That's kind of the general number that I see. And this is just from my personal experience.
And if you want to consolidate your debt, the interest rate from refinancing is lower than the credit cards and the car loans. And
oh my gosh, much lower. Much lower.
Something that I was thinking about in the previous episode is that you said if you access to that equity in your house, you can get cash flow.
Yes.
And you can save on your debts, and with the savings that you are doing, you can reinvest that money. Is that possible?
Correct. Yeah. So basically, it's a very good strategy to follow is that if you have a house and you have a ton of equity in that house, you use that equity for other things. So during COVID, when the interest rates were very, very low, people actually refinanced their house and reinvested that money with their financial advisors because they were growing more money in an investment account versus what they're paying on interest. It's not a safe strategy because you're using your house as collateral for potentially making more money. But if you're very savvy with finances and you can do it, go ahead, right? Like that's not a bad strategy if you know you're going to make money from it. However, a regular person having a house as an asset and growing that equity, you use that money to buy, I don't know, a second house, help your family or your children buy another property, have access to consolidate debt if something happens to you. So instead of dipping into an emergency fund that you can use for retirement and, not tapping to your RSPs or your TFSA, you're basically just keeping the equity out of your house and you're slightly increasing your mortgage payments, but you're consolidating debt, or you're paying for something like an emergency. For example, if your roof leaks or something collapses or you crash your car and your insurance is too high for deductible or you don't have the coverage, you can, instead of taking out another car loan and paying 7% on a car loan or 10% on a car loan, because the car loan interest rates are based on your credit score and they're based on your financial situation as well. And so your car loan could be, I think the average right now is around 7%, which is fairly high. And your mortgage is around 4 to 4.5%. That's a big difference. Right? Over 5 years, it's thousands of dollars.
And if you have your house totally paid, fully paid, you don't have any mortgage on your house, can you access to that financing?
Absolutely. Mm-hmm. And you can refinance anytime. You don't have to do it on renewal. The only thing I would say is that if you're refinancing your house now and it's not when your mortgage is up for renewal, that you are paying a penalty fee because you're breaking your mortgage term. And we see if that makes financial sense, because sometimes somebody will come to me and they'll say, I have $60,000 worth of credit card debt. I really need to pay it off. My credit card interest rate is 19%. That's the typical interest rate on a credit card.
So this option, the refinancing, is when you get another mortgage on your house. So it's different to renew your mortgage, different to switch to another
Correct.
lender.
Yeah.
Is another thing different?
Yes, so they're two different processes. Switching from one bank to another, renewing your mortgage, you're not adding extra money to the mortgage. You're just taking it from one bank to another bank, or you're staying with your bank. Renewing and switching is the exact same thing, right? You're just looking for a better interest rate or a different lender at your time of renewal. So you're not doing anything different. You're not making any other changes. You're just getting a different contract and carrying on with your mortgage at a different interest rate with a different lender. Whereas refinancing, you're adding debt to your mortgage, or your house has no mortgage on it and you're trying to take out money, because you're not buying a house when you're taking out money from it and you're not switching it. You're automatically refinancing it if there's nothing owed on it. So if your house is what we call free and clear, meaning that there's no debt or lien on it, then you want to take equity out of that. It's still a refinancing process. It's the exact same process as if you already had a mortgage.
And if you have the money in cash and you put it in a bank account, can you do the same?
I don't know what you mean.
Because a friend of mine told me
Yeah.
that he said, I won't buy a house. I will bring my money and I will put it in a bank as a guarantee, something like that. And they will lend me money with a low interest rate. Is that possible? Do you know something about that or not?
No, I don't know what they're talking about, to be honest with you. I think that if you open a bank account with that bank and they could see that you have a lot of money, that you're less of a risk to them, but that does not guarantee you a low interest rate.
Yes, because at the end of the day,
Yeah.
it is cash and it can change, right? The property is an asset and this is like a backup, you know?
If you buy a house with cash, then you can refinance it. But if you have cash and it's an investment account with a lender and you want to buy a house, you still have to do down payment. You have to use your own down payment, and you're not going to get a better rate. You have to still qualify for a good interest rate, because there are criteria with every different lender. You have to have good credit. You have to qualify within their ratios, within their debt servicing ratios, meaning affordability, meaning that you still have to afford the house within the numbers that they want you to fit into. And you still have to have a certain type of income. You can't have any exceptions. There's a lot of ways to get a good interest rate, but having a lot of cash is not necessarily one of them.
Okay.
Yeah.
Okay. Thank you so much, Helen. I think that this episode was very insightful because I can see many, many options. Really, I cannot just imagine what is the best for me, for example. But I think that the most important thing here is that people should talk to you, and based on their situation, you can help them to buy the best strategy. Is that correct?
Yeah, and I think even your strategy right now will change over time. What's best for you now might not be the same next year, which is why I say I talk to my clients once a year, especially clients that want to talk to me and want to have the best financial situation based on, the equity in their house and what they're doing in life, right? Some people want to buy a cottage. Some people want to retire. And retirement is a whole other conversation, because when you're buying a house and you're just fresh on the market and you're just bought a house, you're not thinking about paying it off right away. But when you're close to retirement, let's say you're 5 years from retirement, we're having a different conversation about how to strategize your mortgage payments. I might say taking equity out of your house is not the best idea right now. If you want to pay it off in 5 years, we might strategize something different. But if you're a brand new home buyer and you bought a house and you come to me in 5 years' time and you want to refinance because you're growing your wealth, you're building your personal life, or even let's say you're borrowing money from your mortgage to grow your business, which people do, because a business loan is really high interest rate. If you go to BDC or any other place that will give you a business loan, even a bank, when you get a commercial loan or business loan, they're much higher interest rates because it's considered high risk. When you just borrow money from your mortgage to grow your business, again, it is a risk because it is your house and you're borrowing money against that, but you're borrowing that money at a lower interest rate. So that is, I see people do that all the time, is when they're growing their business, they're actually using equity in their home to do that.
Oh, I can understand now how is happening everything here. Okay, Helen, thank you so much. So what is the best place where people can find you or reach out to you?
You could find me on my website at gondamortgages.com. You can ask me questions or drop a link in the video and I'll reach out to you. And you can also call me at 902-237-1112 on my business phone.
Thank you, Helen.
Thank you.
You have the equity, but how do you actually spend it? In our final episode of this series, we are talking about the HELOC, the credit card attached to your house. Is it a dangerous debt trap or a strategic power move? Learn more in the next video. See you there.